Welcome to today's discussion on growing a property portfolio with the BRRR strategy. BRRR, which stands for Buy, Refurb, Rent, Refinance, is a proven method for maximizing real estate investments. In this video, we'll delve into each step of the BRRR strategy, guiding you on how to acquire, improve, rent, and refinance properties to expand your portfolio. Let's get started. Step 1. Buy. The first step in this strategy is to acquire properties that are suitable for this investment approach. This involves finding properties that have the potential for value appreciation and rental income. Here's how you can go about it. Finding distressed properties. One of the key aspects of this strategy is acquiring distressed properties that can be renovated and improved to increase their value. These properties can often be found through various channels, such as foreclosures, auctions, or off-market deals. Foreclosed properties, for example, are typically sold below market value, presenting an opportunity for investors to acquire properties at a discount. Thorough due diligence. Before making any purchase, it's crucial to conduct thorough due diligence on the property. This includes researching the neighborhood, assessing the property's condition, and estimating repair costs. It's also important to analyze comparable sales in the area to ensure that you're getting a good deal. Negotiating favorable purchase terms. Negotiation skills play a vital role in acquiring properties for this strategy. Whether you're dealing with a bank-owned property, a motivated seller, or a distressed homeowner, being able to negotiate favorable purchase terms can make a significant difference in the success of your investment. This may include negotiating a lower purchase price, favorable financing terms, or additional concessions from the seller. With regards to the actual purchase itself, this strategy is normally funded by a cash purchase or through a loan such as bridging finance. The reason for this is that you want to purchase the property and add value to it, and then approach the mortgage lender and ask them to lend against the higher value of the property, so you can take your initial investment back out. This is not really possible if you initially buy the property with a mortgage, as you normally have to wait a period of time of, say, 1 to 2 years before you can remortgage at the higher value, whilst with a cash purchase, you ideally want to be in and out within 6 to 9 months. Step 2. Refurb. Once you've acquired a property through this strategy, the next step is the refurb. This phase involves renovating or improving the property to increase its value and appeal to potential tenants or buyers. Here's how you can effectively navigate the refurbishment phase. Budgeting. Before starting any renovations, it's essential to create a detailed budget outlining the costs associated with the project. This includes materials, labor, permits, and any other expenses related to the refurb. Having a well-defined budget will help you stay on track financially and avoid overspending. Hiring contractors. Unless you have experience in construction or renovation, it's advisable to hire qualified contractors to handle the work. Look for contractors with a proven track record of delivering high-quality work within budget and on schedule. Obtain multiple quotes and thoroughly vet potential contractors before making a decision. Obtaining permits. Depending on the scope of the renovations, you may need to obtain permits from the local authorities before starting work. Make sure to familiarize yourself with the permit requirements in your area and obtain all necessary permits to avoid any legal issues down the line. Managing the renovation process. Effective project management is crucial during this phase. Keep track of progress, communicate regularly with contractors, and address any issues or delays promptly. Staying organized and proactive will help ensure that the renovation process proceeds smoothly and according to plan. Adding value. Focus on making strategic renovations that add value to the property. This may include upgrading kitchens and bathrooms, improving curb appeal, or adding desirable amenities. By investing in renovations that appeal to potential tenants or buyers, you can maximize the property's value and rental income potential. By carefully planning and executing the refurbishment phase of the strategy, you can transform distressed properties into attractive and profitable investments. Step 3. Rent. Once the property has been successfully renovated, it's time to enter the rental phase of the strategy. Finding tenants. Start by marketing the property to attract potential tenants. Utilize online listing platforms, social media, and local advertising to reach a wide audience. Consider partnering with a reputable real estate agent or property management company to assist with tenant placement. Conduct thorough screening of prospective tenants to ensure they are reliable and financially stable. This may involve running background checks, verifying employment and income, and contacting previous landlords for references. By carefully vetting tenants, you can minimize the risk of rental defaults and property damage. Research rental rates in the local market to determine a competitive price for your property. Take into account factors such as location, property size, amenities, and market demand. Setting the right rental rate will help attract quality tenants while maximizing rental income. Managing rental properties. Effective property management is essential for success as a landlord. Stay proactive in addressing maintenance issues, responding to tenant inquiries, and ensuring compliance with rental regulations. Consider investing in landlord insurance to protect your investment against potential risks and liabilities, and consider outsourcing the management of the property to a third party. Step 4. Refinance. The refinancing phase is a crucial step in this strategy, allowing investors to access the equity built in the renovated property. Refinancing involves replacing your initial investment with a new loan, typically with more favorable terms. In the context of this strategy, refinancing allows investors to tap into the increased equity of the renovated property. As an example, you purchase a property, including legals and stamp duty, for £90,000 and the refurb costs you £30,000. So you have spent £120,000 in total. For this example, the market value of the property is estimated at £160,000. You approach the mortgage lender and ask them to refinance your property with a loan based on the £160,000 with an LTV of 75%. The mortgage you obtain is for £120,000, which covers your entire spend to date. Therefore, you have essentially pulled out all the money you put into the deal and have a free property where the monthly mortgage cost is now being covered by the rent. The money you pulled out of the deal can then be invested into your next project, and you rinse and repeat the cycle. The concept of rinse and repeat is fundamental to this strategy. As investors successfully complete the BRRR cycle with one property, they can reinvest the proceeds to acquire additional properties and repeat the process. This compounding effect allows for exponential portfolio growth over time. In summary, the BRRR strategy offers a systematic approach to real estate investing for portfolio growth. By buying distressed properties, refurbishing them, renting them out, and refinancing to access equity, investors can leverage their resources effectively. However, it's crucial to approach this strategy with caution and thorough research. For more insights on property investment, subscribe to our channel and empower yourself with the knowledge to make informed decisions on your financial journey.